Your name is Mr. Nagamoto. We're going to discuss the accounting. The topic for today will be real issue and the question. This is a brief of which every aspect of the accounting involves termination of both of items, termination of services, offered, and so on and so forth. And when we are to produce materials, one of the elements, of course, our production is material. The element of production is that of labor, and also we have overheads. So the discussions on overheads and labor is another topic. Those will come later. So for today, we want to basically go back and understanding what entails in material costing, the labor needs of material issues. Now, when within an organization where manufacturing is happening, usually we have a storekeeper. This storekeeper will be in charge of keeping the stock of raw materials and finished goods. However, our emphasis is on these raw materials which are critically released to the production department for the production of finished goods. Now, when these goods are being produced, it is important for the organization to establish the cost of those production, the cost of those goods produced, so that eventually when they are being sold to the market, the company knows on a price. That is to be that when they are priced, we take into account the cost of production, so that the company can be able to leverage some profits. Now, in this regard, for purposes of accounting for materials that are issued from the store, the storekeeper, we have several approaches that are used depending on the policies and the circumstances that prevailing at any given time. Now, we are going to use these particular methods and then discuss them one by one. And the discussion will be revolved around one question, the particular question which I believe already presented to you. And so the method that will be used in basically in issued materials, we have what we call FIFO. FIFO means each of those letters stand for something. FIFO means pass in, pass out. That is to mean that if we bought materials from the outside suppliers and happen they are now in store. Now, when the materials are being issued for production, the production department, the storekeeper will issue them in such a way that whatever came into the store first will be the first to go out, will be the first to be issued the production. Remember, this consignment, this receipt of materials are actually acquired from different suppliers at different prices. So we also have what we call LIFO. LIFO stands for last in, first out. So the last in, this is to say that within the material that the storekeeper has, whatever came in last is the one that is to be issued to the production department for purposes of determination of material and cost. Also, we have what we call weighted average price. We shall understand what that means. So weighted average price basically takes into account some number of people. So we shall have to be able to understand it when we get there. We also have what we have weighted average cost. So they also have that like that cost methods and so forth. But we are going to embark on understanding these particular four categories. Because if you look at the exams, mostly the exams involve around these other four. And so our interest, our time is definitely on those four. I'll say that this is material costing, and material costing pertains to termination of the cost of the material, the goods that are produced. And I'll say the goods that are produced by the organization, the cost of it may consist of labor cost, overhead cost, and material cost. And I've said that overhead cost and the labor cost is a topic for the discussion on another day. For us today, starting to be able to emphasize on material issue. Now, I've said that there are two methods we are using in the determination of our material issue. I talked about first in, LIFO, last in, first out, weighted average price. Of course, as I've said, the materials get into the store and they are having from the suppliers at different prices. And that's why we have all these people, LIFO, weighted average price, and weighted average cost. Now, we can study the first part. And the first one is actually about people. As I've said, people means fast in, fast out. Fast in, fast out. What came in fast has to go out fast. And I've said the accounting for these materials is done by the storekeeper. And the storekeeper maintains a ledger account, called store ledger account. So we have this store ledger account because it is from the store. It's kept by the storekeeper. We call it store ledger. Store ledger account. And this is account basically to account for the materials that are being received by the storekeeper and are also being issued by the storekeeper to the production and department for the purposes of producing the finished goods and for the purpose of determining the cost of those goods which are produced. So this store ledger account basically it is simple. The storekeeper receives, so we have receipts. He issues, so we have issues their column and we have balance column. So it is actually subdivided into three. We have what is called receipts column. Receipts. We are receiving from suppliers. We are buying and purchasing. Then what when we receive, we are going to issue them. So we have issues. Issues come from issuing. And then when we issue, what we have in the store will not be the same. It will be reduced by the amount of the goods that we have been issued to the production department. So we shall be having, and the last column, we shall be having called balance. Balance column. So remember what I'm saying? Receipts, issues, balance. That's basically now all the receipts. The first thing that we have shall be having the date here. The date shall be having the date. The date here. And each of these major columns, they will consist of other sub columns. So we have what we have the unit, cost per unit. And we have the amount of value. You can call it amount of value. So this is for the units. Cost of each unit that's per unit. And then the amount or value. The balance also remains the same. Unit. Unit is the same thing as quantity. Cost per unit. Cost per unit. And then we have the value. So you divide them into those columns for purposes of doing your accounting for the materials. And so this is what we have. Now, as you see this particular account, you can see we are in the store ledger account. It is the storekeeper who's accounting for the materials that are issued and eventually the materials that are received from the suppliers and eventually issued to the private department. So whatever we receive, whatever we buy from the suppliers are recorded on the receipt column. Whatever we issue to the production department are recorded on the column issued to the equity. And at the end of the day, determine what is the balance after we issue, because we are issuing from what we have. Now, it may be happen because this store ledger, it may be for a given month. Let's say this is store ledger, the store ledger for the month, store ledger account for the month of April. Now, if in the beginning of this month, we are some stock at the in the store. So now you simply post them directly to the balance figure because they are the balances. They were not received at the start of that period. You simply post it on the balance. You have to be very careful with the equation, so that basically you don't have to make errors. Now we want to look at this question. As I've said, we are going to discuss those four methods: the LIFO, the FIFO, the weighted average price, and the weighted average cost. Actually, we are going to use one equation for purpose of all those four methods. We start with the first one, and we have said the first one is that of FIFO. The FIFO. And I've said FIFO simply means fast in, fast out. What the storekeeper brought in fast, those are the items he is to issue fast. And once they are exhausted, we will have to go to the next consignment and so on and so forth. So the guiding criteria, of course, the field is there for you to see. You have to be able to see the question on the board so that you have to be able to discuss it together. Now, let's look at this question and read it together for purpose of understanding this particular area. So, Katana Limited uses material M50 in its production process. You can see they are doing production. When we are producing this, the output is actually finished goods. And these finished goods, they must be sold to the market at a price. And so you must avoid underpricing. The only way for us to be able to do that is to accurately account for the materials that we are receiving from the supplier. So we have been told Katana Limited uses material M50 in its production process. Following information relates to the material for the month of June 2022. So we have example that month. So June 1st, purchase that, units of that. June 2nd, June 9th, purchase that. So essentially, you record them the way those events are happening. So the first thing that's happening is that on June 1st, so we have on June 1st, on 1st June, what is happening? Purchasing. When we are purchasing, is that we are receiving. We are receiving from the supplier. So any aspect of purchases, as far as this is concerned, is an aspect of receipt. So we are receiving. So how much are we receiving? We are receiving 2,000 units. And these are in units. These are in shillings. And these are not in shillings. These are in units. So essentially, we are purchasing 2,000 units. And how much? So the price at which we are buying them is 100. So your work is going to multiply 2,100 for purpose of getting the amount in that particular consignment. So this is 200,000. So we've not been told about any balance that was available in the beginning of that month. So we are assuming that when we are on this month, when we are beginning this month, we started from zero stock. We started by zero stock. And so we assume that this item that we are provided on 1st June is what shall be there at the end of that particular date. The unit again, the price is 100. The price is 100. The value is 12,000. So for each day, you are aligned. So we are done with that. We go to the next item. So June 9th, purchase 520 units at 105 per unit. Again, remember, this is June 9th. 9th June. What is happening here? We are actually doing the purchases again. Purchases means we are receiving. It's on the receipt column. So how much is being received? We are purchasing 520, and therefore we are receiving 520. So it is 520 units. The price per unit is given there is 105. 105 divided by 5 what it is. Let's do the multiplication. So we have 520. So we have the 520 times 105. That gives you 54. 54,600. Now, you can see that at this particular juncture, there are two consignments. There was a consignment that was given first, and there's another one which has been received this time. So on the balance column, you have to indicate clearly those two compartments on a chronological order. So we start with the first one that we have received on that day. It means that we have containment and this, and this is one down. So we have this containment, which is representing as 105. That goes to 54, 600. Now, the purpose of using this column in this manner is to enable you to determine which consignment are you supposed to issue to the production when basically the production department requires you to issue that. Remember, you are preparing this from the point of view of the impact. Now, having been said, as I said, you analyze each date there. That is to mean that the deadline, the deadline. Now, you go to the 10 issues 1,020 units. Now, we are issuing, we are no longer buying, we have them. These are the items that we have in store, let's stock them. Now we are issuing. When we are issuing, we have to be guided by the method that we are using. The method in this case is people. Fast in, fast out. Fast in, fast out. Whatever came in fast is the one to go out fast. Now, if you look at this consignment that we have in the store at this point in time, it is obvious and it can be seen here that the 2,000 of the first we acquired, the first was acquired first, June indicated there. Then it was followed by the next consignment of 520, which was acquired on 9th June. Now, at this point of the issue, the 2,000 must go out fast. It is only after it has been exhausted that we must then proceed to start issuing from the next consignment. Now, at this juncture, we will go to issue 1,400. You can see 1,400 can, the all of it can actually be able to be issued from 2,000. So we're going to do it here. We are going to write the date here. And the date is 10. And what is happening here? The issuing 1,400 units. And what is the price that we're using? It is fast in, fast out. Therefore, this is what we're giving out. It is 100. Because 100. So this is going to be 100. That gives you 14 on 40,000. Now, what's the balance? The balance is obvious. This 2,000 has been reduced by 1,400 with which the amount of which has been issued in production. That is the difference. And that is going to be 600 at 100. So that means 50,000. It means the first consignment that we had, what is now available for is 600 units. But the second consignment is still inside 520,105. Remember, I'm saying the reason as why we are listing in this manner is for you to be able to communicate which one is to go out fast and so forth, depending on the method that you're using. Now we have done the second tool. We are proceeding to the next step, and that is on yellow. On yellow tool, get a look at what's happening. We still 800 units. So on yellow tool, we are receiving 800 units. So it's 800 units. The value is 115. So 115. You are getting multiplied. Determine how much is it that you have received on the 7 days. So it is 800 times 115, and that gives you 92,000. 92,000. 92,000. And so at this point in time, you can see that as the 2% that we have, we are receiving a new consignment from the supplier into our store. So as a storekeeper now, the storekeeper now has 3 consignments which were brought to the store at different dates. The first one, as I said, you must list them because the sensitive determining which is the stock to go on first. And so the first one, 600,600, 100, just there, 60 that. The next is 520, 120, 105. This is the cost, 600. Then we have that one that we just received. Is 800. This is 115. That is 2,000. Now, again, something every day is close. Now, the next item is having 114. Again, this is the receipts. So you continue receiving them. Depending on the date. So we have 14. Again, we are receiving how much? We are receiving 600. And that is 121. Multiply again, find what it is. So it is 600 times 125. And that is 25,000. This is 75,000. Now, you continue that down there. So we have 600, we have 520, we have 800, and then we have received 600, another 600. These are different prices. So this was 100, so 60,000. This was at 105, so 54,000, but 4,600. This is 800 at 150. We want to be 50. This was 92,000. So just receive a record point which is at 125,000, 125,000. This is at 75,000. Now, I will proceed. So you just compute this way until the last date. Now we proceed to the next date, and that is 15. And no, that is 16. So on 16, what is happening is that there is issue of 1,240 units. Now, I'm going to the first column because I'm running up the stairs. So I'll be done as I proceed. But you see, 7 minutes. No. On this day, we are 16. You look at what is happening on 16. Issues 1,040. Now you want to argue and reason out which method are we using? Past and past of people. Now look at the result here. We have 1,240. The first one is to go at 600. Then 520 is follow that 520. That is 0, that is 1220. You can see, no, that's 1120. 1120. 16 is 120. 120 come out of that. So of course 120 come from that. So we have this. Another 120. This is 0, 4, 2, 1. So this is the first consignment, the second consignment, third consignment. So we are going to use it in that order. The first one is have to go out from it. Then the second one. Then from the next consignment, we are only going to take out 120 because the air was actually for us to be able to reach 1240. Now what we do here, we are issuing a so how much are we issuing? We are issuing 600 and how much? 100,000. That is 600,000. 600,000. No, this is 600. This is 60. This is 60. Then we also issuing another 520. 520. We're issuing at 105. This is 54. 600. Then the third one, 120. 120, we are issuing at how much? At the 150 or 25,000. So the first one, we take 150. So it's 150. Yeah. 150 times 120. Let's see how much is it. 120 and 115, that gives you 13,800. 13,800. Now, I want you to see what's happening. We were doing for 12 units. But if you look at our scope, we have 1, 2, 3, 4 consignments that were received received on different dates. The policy for us is that we are supposed to issue the first item that came in first, then the second, so and so on and so forth. That's why we issued 600, we issued 520, and the next out of 800, we only needed 120 to make it of 1240. Therefore, the balance of this just remember this is God, and this is also God. We are remaining with 800 minus 120, 800 minus 120. So we are remaining with 680. So the balance here will be 680 of this and 600 of the last one. So we have 680, that's 125, 75,000. And this is another one. It's 680, it's at 680 at 150. So that gives you 680 and 115. That is 78. 78 to 100. Now that's one. As far as this data is concerned, we have all these 3 items, they make up the result of your issue. We will go to the next stage. The next stage is actually on 20th. So on 20th, we are doing the issuing. And how much are we issuing for 80? So again, you have to argue out, you can see what's available on the last date was the 680 that was the first consignment, then they sold by 600. So at this juncture, we are only issuing 80, and we are able to see that it can make it good. Now it can come out from the first consignment. We shall be having 480 at 115. Determine what it is. So 480 times 115. That gives you 55,200. 55. Where are we? So we are this is 480. This is 115. This is 55, 255. 55, 200. Now, this 480 has come from this first confinement. So this would mean that this first confinement has been reduced by that, and therefore we are only remaining with the 200 of each. So at 150, we get how much is this? So this is 200 times 115. That is 23. 23,000. Then the next data consumption has not been touched. 125, it is still 75,000. Then we proceed to the next week is 25th and 30th. And as I said, I'm going to wrap this up for purposes of continuity. So we are 25th. 25th. What is happening? Received 1,000 units. So if I receive after your side, so 1,000 units are how much? At 110. So you see multiply and that's 110,000. And then you will run happening at that point in time. Now we have 200 and 115, that was 23,000. We had 600 at 125, this is 75,000. And we have a new consignment which is 1,000 units. There is 1,000 units there at 110,000. That is 110,000. So that is what's happening on this. Then eventually on the last day, issue 760. Now 760, just have to go to what we had. We had 200, the first has to go out first. Then 200 per 600, then 600. It means that we are not going to exhaust the second consignment. So in there is 130th issued. Now we have to reach the first one first. So we are issuing the 200, then something it. So this one is giving. This is 23,000. Then, because it was expenses that were issuing, and we are reaching 200, we are remaining with half 480. So it is from the second consignment, you're going to get 480. It will be 480 and 120 times 125. That gives you 480 times 125. 480 times 125. That gives you 60,000. That gives you 60,000. Now, what is the balance? Remember, the first consignment is already gone. The current is gone. So, on the 600, you are partially used it. What is remaining is the difference between 600 and that. It's 120. So, the last time we have 120, the full out of this, you have 150, and you have this 1,000 and 110, which is the impact. You multiply the price of this, so 120 times 150, 120 times 150. That gives you 13,800. 13,800. That is that. Now, that is what you've been told. So prepare a storage account using the region. So of course, we were using what is called fast in, fast out. Now, I hope you are not following what you've been doing and you'll be able to enjoy the class. Now, you may also be told this can determine the closing stock. Now, if you ask about the closing stock is simply this portion and detected. Suppose that is the question. And that is the mask for you to determine the closing stock. If you're there on these things, then the closing stock will not be an issue. And it's going to be a short-based mark on those. When you talk about the closing stock, it will simply be just pick the way down. 120 and 115, that is 13,800. 1,000 and 110, that is 110,000. And then you got all this. This is 800, this is 3, this one 123,000. That is the value of the closing stock using the fast in, fast out method. Fast in, fast out method. That's the meaning. So how to the class has been enjoyable and you can see the concept behind the people. Next time we meet, which is probably tomorrow or the day after, we shall discuss again the next method, that is LIFO. And after you've seen what you've been doing here, you prepare it from the storekeeper's point of view. And you are assuming that the farm is engaged in the production of finished goods. And these finished goods are produced using raw materials acquired or bought from the suppliers. And these materials are acquired at different prices. And it's important for us to be able to value this material issue because of them, because eventually you want to know, you want to ascertain the cost of the goods that you have produced, so that you don't underprice, because if you underprice our products, it simply means you're going to have incur losses. And the aim of every organization that is engaged in production or any business oriented organization, basically should be able to generate profit. So in this case, you see that their methods are actually can be used for different organizations. So they may be FIFO first in, first out, LIFO last in, first out, weighted average price, and weighted average method. I've said that for first in, first out, what came in to the store first. When the storekeeper is requested fish materials to the production department, those consignments that came in first are the ones which are to be issued to the production department first. And they are very close, which they were actually acquired. The ones that first consignment is exhausted, it is no more, then the storekeeper now to look at the second consignment that came into the store. That second consignment again is to be used, distributed to the store, the restaurant. Once it's exhausted, the next consignment is issued at its own price and the cost at which it was acquired from suppliers. And so that's the logical consequence of this particular ledger account. And so we talk about store ledger account. It is from the store. It's accounting for what we are receiving and what we are issuing, and the balance at the end of the day. That's all we have to say. I believe the class has been interesting. Until we meet next time, bye.